Good morning, guys. Welcome to my channel, Learn Accountancy with Prasadar. So today we are going to discuss about Ind AS 2 inventories. This is part of the weekend series which I started last week. Last week we discussed about Ind AS 16 property, plant and equipment. So it's very important to understand why or what is the need for Ind AS 2, the standard on inventory. Okay. So what are we going to learn in this standard? First is we are going to learn what forms part of the inventory. And second, we are going to learn the valuation, how the inventory should be valued. Okay. And inventories are generally a very significant part of the financial statement, especially for manufacturing and trading entities. So the valuation of inventory is very significant when we draw the financial statement, when we are preparing the financial statement, the valuation of inventories, it takes a very significant position. Okay. So in this standard, we will be discussing about the recognition criteria, the measurement, the valuation, and the disclosure of inventories. We are going to discuss in this standard, guys. Okay. So as I said, what is the objective of this standard? What India tries to achieve? To prescribe the accounting treatment. So we will get to know the accounting treatment of inventories here. Okay. And the next major thing that will be addressed by this standard is the key issue. Okay. At what value the inventory has to be recognized. These are the two major things that will be discussed. And what happens when a revenue recognition is happening or when a sale is recorded, what happens to the cost of the inventory that we are going to discuss in this standard. Okay. So now let us understand what are the exclusions and inclusions in this standard. Okay. So inventories which are covered under construction contract. Okay. Work in progress under construction is covered under in construction contract is covered under Ind AS 15, which will not be dealt by the standard. Financial instruments will not be dealt by the standard. And biological assets related to agricultural activity will not be dealt by the standard. Okay, so what we'll be covering? We will be covering inventory of raw material, inventory of work in progress, inventory of finished goods. Okay, goods which are purchased mainly for resale. This is mainly trading activity, and material and supply for services. These are the inventories that will be discussed. Okay, so this is the basic framework about Ind AS 2. So the learnings from this standard will be what what is inventory, and second, how the inventory has to be valued. This will be the major learnings from this standard. Okay. Now let's get into the definition, guys. See, for any standard, the definition, the recognition criteria, the valuation, they play a very important role. Okay. So let's, as per Ind AS 2, the definition of inventory. The definition of inventory. What is the definition of inventory? Inventories are assets which are held for sale in the ordinary course of business. Okay. Inventories are assets which are held for sale in the ordinary course of business or assets in the process of production for such sale or in the form of material or supply to be consumed in production or for rendering of services. Assets which are held for sale, that means this is mainly related to trading activity. This is mainly related to trading activity, or this will be uh, like a trader, he purchases some goods for the purpose of resale. So the goods are already in a process form, it can be directly sold. So that is the point which is discussed under this. These are held for sale, which are in the process of production. Assets in the process of production is this is work in progress. That means you are using an inventory for doing further production. It is under the process of production that is called as work in progress. In the form of material and supply to be consumed in production or rendering of services. These are all raw material. So inventory of raw material, inventory of finished goods, or inventory of work in progress. This will be covered in the services. So these are all in the form of material or supplies to be consumed in production or for rendering of services. Clear, guys? So inventory can take the form of inventory of raw material. It can be inventory of finished goods, or it can be inventory of work in progress. All these form parts of inventory. This is covered by this standard. This is covered by this standard. Okay, this is covered under IND AS 2. Clear? Okay. Now let's get into the principle for valuation. In IND AS 2, what is the principle for valuation? You can see the highlighted thing. What is the measurement rule in IND AS? The inventories are always valued at cost or net realizable value, whichever is lower. Whichever is lower. See, the same definition or the same valuation principle was there in accounting standard also. In accounting standard also, coincidentally, it was AS2, and when it is IND AS, it is still IND AS2 actually. So the fundamental rule of valuation of inventory is inventory should be valued at either at cost or net realizable value, whichever is lower. Okay. Now let us try to understand why inventories are to be valued at cost. Why not at sale price? Okay. Because see, inventories are items which are either held for production, as in the form of raw material, or are in the production process, which are in the form of work in progress, or they are in the form of finished goods, which are held for trading actually. Clear? So all these are items which are still lying with us, which has not been sold to the end customer. So a profit element cannot be added. A profit element we cannot add to the inventory. So this principle ensures that inventories are not carried at an amount higher than the expected to be realized from their sale or use. Okay. So this is more of a prudence concept wherein we value the inventory either at cost or or at net realizable value, whichever is lower. For example, if we purchase the inventory at 100 rupees, if we purchase the inventory at 100 rupees, the inventory can be valued at 100 rupees. And if the realizable value of the inventory is say 120, the inventory will be valued at what? The value lower of the two will be 100. Same, one more example. If the inventory is valued at cost is 100 and the net realizable value is 80, again we will follow the prudence principle. It says this accounting standard mandates that inventory has to be valued at cost or NRV, whichever is lower. So in this case, inventory will be valued at 80, which is the lower of the two. Clear, guys? So inventory will always be valued at cost or net realizable value, whichever is lower. Clear? Now, when we talk about cost, when we talk about cost, what are the things that can get into cost? When we talk about inventory cost, what are the things that can get into cost? Obviously, the purchase price of inventory, the import duties, which are non-refundable in nature, transport and handling cost. If you remember our discussion in IND AS 16, when we discussed about the cost of the assets, the same thing we discussed actually. The purchase price will form part of the cost of the inventory. Import duties, if they are non-refundable in nature, we discussed about if the materials are procured along with GST and we can claim the GST input credit. So in that case, the GST will not be added to the cost. Okay. For example, if the inventory cost is 100 and the GST is 10, the GST component is 10, and this GST ITC can be claimed, input tax credit can be claimed. Okay. So the inventory will be valued at the cost of the inventory will be taken as 100, not 110. If import duties are non-refundable or cannot be claimed, then in that case the valuation will be at 110. The cost will be taken as 110. Okay. Next is, this is the purchase cost, which includes duties which are non-refundable or which cannot be claimed, and obviously the transportation and handling cost. Okay. Then the cost of conversion. What do you mean by cost of conversion? The direct labor and the systematic allocation of fixed and variable overhead. Okay, so any direct labor which is incurred during the conversion process that can be added to the cost of the inventory. And other cost incurred in bringing inventories to the present location and condition. Again, we discussed this in detail in IND AS 16 property, plant and equipment also. Any cost which is incurred to bring the inventory to the location and condition which is ready to use. That means if we are purchasing an inventory from 50 kilometers away and our factory is 50 kilometers away, so the transportation cost to bring the inventory to the location and to the condition which makes it available for use, that transportation cost can be added to the cost of the inventories. Clear? And similar thing, this trade discount, rebates and similar items which are deducted are not considered as part of the cost of the inventory. So we can repeat this. So what are the items that goes into the cost? One is the purchase price, any taxes which are non-refundable or non-claimable in nature, any direct labor uh, which is incurred to convert the inventory during the production process that can be taken. Next is any cost which is incurred to bring the inventory to the location and condition so that it can be used, that can be added to the cost of the inventory size. Clear? Now let us understand what is cost of conversion, guys. Direct labor. See, when we talk about cost of conversion, this is the cost of converting the raw material to finished goods. The conversion cost that is incurred in the factory to convert the raw material into finished good, that is called as a conversion cost. So obviously the wages which are directly attributable to production, we have to include in the conversion cost. The wages that we pay to the laborers or the workers, that will form part of the cost of the inventory. Fixed production overhead. See, if there are production overheads, that will be allocated based on normal capacity. So whatever will be the normal capacity of the factory, the fixed overheads will be allocated based on the normal capacity. Variable production overheads, this will be allocated based on the actual use of production facilities. Okay. So if 10,000 units are produced, the variable cost will be different. If 20,000 units are produced, the variable cost will be different. But fixed production overhead is always based on the normal. If in a day 10,000 units can be manufactured, that is the normal capacity, not the actual capacity. The normal capacity, if it is 10,000 units and the fixed overhead is 10 lakhs, so 10 lakh divided by 10,000 units. So that way we have to calculate the fixed production overhead to be allocated for us. Clear? So direct labor, fixed production overhead will be based on normal capacity, and variable production overhead will be based on actual capacity. Okay. There are certain exclusions from the cost of the inventories. There are certain exclusions from the cost of the inventory, certain exclusions from cost of inventory. What are the exclusion, guys? Abnormal waste. Abnormal waste will not form part of the cost of the inventory. Okay. Admin overheads. Administrative overheads will not form part of the cost of the inventory. Selling cost will not form part of the cost of inventory. Okay. Storage cost, unless it is required to initiate the next process, those costs also will not form part of the cost of the inventory. This is very important, guys. Net realizable value. See, we discussed about two components, right? The inventory has to be valued at cost, or it has to be valued at net realizable value, whichever is lower. So we discussed about the cost. So the cost contains what? Going back to the cost, what are the components of cost? It contains the purchase cost, the cost of conversion, and other costs. That means the cost incurred to bring the inventory to the location and condition which makes it ready to use. Okay. Then we discussed about what is a conversion cost. Conversion cost is direct labor, fixed production overhead, and variable production overhead. Okay. Costs which are excluded from inventory: abnormal cost, abnormal waste, admin overhead, and selling cost. Okay. Now let us understand net realizable value. See, net realizable value is if today I want to sell the inventory, what will be the selling price of the inventory in the ordinary course of business? Net realizable value is the selling price. If I'm going to sell the inventory today, the unsold stock, whatever stock that I am having, if I'm going to sell it, what will be the market value, or what is the amount that I'm going to fetch from the market? That is the estimated selling price. Okay. Now, see, we cannot sell the inventory as is, right? If it is in the stage of production, if it is partially completed, no one will buy the inventory until it is fully completed. So less completion cost. The cost which is incurred to complete the inventory so that it converts to a finished goods, and that is when we can sell the inventory. So what are the estimated cost to complete the inventory? Second is selling cost. If there are any costs associated with selling, like if you are giving a commission, or if there are any costs incurred with respect to selling the inventory, so that has to be reduced. So the market price, in simple word, it is the market price less future cost incurred that needs to be incurred to complete the inventory, less any associated selling cost. That will give us the net realizable value. So this NRV or cost, whichever is lower, NRV or cost, whichever is lower, the inventory has to be valued in NRV or cost, whichever is lower, guys. Clear? So what is net realizable value? It is the estimated selling price less future cost required to complete the inventory, less selling cost. That is net realizable value. Clear? See, there may be a case that we need to write down the inventory, or we have to reverse the inventory. When circumstances that causes inventory to be written down or no longer exist, or when there is a clear evidence of increase in net realizable value, the amount of write down shall be reversed actually. Okay. See what it means. If the inventory are not in saleable condition at all, if the inventory is not in saleable condition at all, we have to write down that inventory, because the net realizable value will be zero, right? In such case, when the net realizable value is zero, we cannot record the inventory at cost, because the standard says cost or NRV, whichever is lower. Okay, so we have written down the entire inventory. Now suddenly, due to certain conditions or certain factors, whatever we thought cannot be sold, now we are able to sell the inventory at a marginal price. So if there is an NRV again established for the inventory, then whatever we had written down previously, to that extent we can restore that if there is an NRV which comes on a later stage. For example, if the inventory value was 100 and net realizable value was 0, so entire 100 was charged to the P&L account. Entire 100 was charged to the P&L account. Okay. Now suddenly the 100, now entire 100 rupees already charged to the P&L. Now the NRV, now we, due to some reason, we were now able to get rupees 20 for the inventory. So 100 rupees which is already written off has to be reversed actually. So I will reverse the 100 rupees entire loss to the extent of 20. So that means there will be a return write back which will be happening. There will be a write up which will be happening to the extent of 20. So my 100 rupees I recorded as loss. My loss will now get reduced by 20. My ultimate loss will become 80 only. So 20 rupees will be an gain for me because the net realized value has increased. Clear? Now, key disclosure requirements. See, every standard has a disclosure requirement. So what are the disclosure requirement in inventories? The policies adopted in measuring inventory, including the cost formula, means what are the things that has got into the cost of the inventory? What is the carrying amount? The total carrying amount of inventory and appropriate classification, whether it is a raw material, whether it's a finished goods, whether it's a work in progress. Expenses recognition. What is expense recognition means, guys? See, whenever an inventory is sold, whenever an inventory is sold, that means an actual sale has taken place. The corresponding cost with respect to the inventory has to be considered under cost of goods sold. So when there is a revenue recorded, sorry, the corresponding cost also has to be recorded. The corresponding cost has to be recorded as cost of goods sold, so that the revenue and the cost both are recorded in the same period. Write down that I already mentioned. If there is any written down, write down which is happening for the inventory, like the net realizable value becomes zero, the entire revenue has to be written down. If the inventory is pledged as security, see, sometimes it happens that when we go for a loan or an overdraft, the bankers ask for some security. So if inventory has been given as security, then that fact has to be mentioned in the disclosure. That fact has to be mentioned in the disclosure. Okay. So the common area of testing in exam can be there can be practical sums on cost or net realizable value, whichever is lower. You can be tested on the valuation principles. You can be tested on net realizable value concept. Okay, you can be tested on the inclusion and exclusions of under cost. We discussed on the inclusion of and exclusion under the cost, right? Components of cost. So the cost of purchase, cost of conversion, and other costs, you can be tested on this principle. Okay. So mainly, it's a very simple standard which covers what is an inventory, what is the valuation principle, okay, what should be included in cost, what is net realizable value, and followed by when inventory has to be written down, and the last topic will be what are the disclosure that is required under this standard. Okay, so this was a simple understanding of Ind AS to inventories. You can follow my channel Learn Accountancy with Prasadar in YouTube. My channel is by the name of Learn Accountancy with Prasadar in YouTube. And in LinkedIn, I am available by the profile name Prasad Ramachandran. Guys. Next week, next weekend we'll be covering another standard. So subscribe my channel for more updates on Ind AS. Happy learning, guys. Thank you.